Alongside the usual chorus of doommongers, CEOs like Sam Altman, Jeff Bezos, and Mark Zuckerberg have all admitted, to varying degrees, that AI is looking a bit bubbly, despite the fact that they have an incentive not to. Even hallowed institutions like the IMF and Bank of England, who usually stay out of this sort of thing, are now sounding the alarm. So in this video, we thought we'd explain why AI looks like a bubble.
America's economy looks unstoppable. Record stock prices, booming AI investments, trillion-dollar corporations rewriting the future. But beneath that glitter lies a terrifying truth. The US is now more dependent on artificial wealth than at any point in its history. 40% of GDP growth is fueled by AI spending, while 80% of stock gains come from a single sector built on speculation and debt. The same technology celebrated as salvation may be the fuse of the next collapse. Because when the illusion breaks, the crash won't just hit Wall Street, it'll hit every American home. The AI revolution was sold as humanity's next great leap, a force that would change everything from medicine to manufacturing. But behind the marketing slogans and investor hype lies a brutal imbalance that few want to acknowledge. In 2025 alone, American companies are pouring over $400 billion into data centers, chips, and AI infrastructure. By 2028, that number is expected to explode past $2.9 trillion, and by 2030, it could reach a staggering $6.7 trillion, according to McKinsey. Yet the entire AI industry is projected to generate only $50 billion in revenue this year. That means for every dollar AI earns, $7 to $8 are being spent to keep the illusion alive. In historical terms, this ratio is catastrophic. During the 19th century railway mania, the figure was 2 to 1. In the dot-com fiber optic boom, it was 4 to 1. Both ended in spectacular collapse. Today, AI's 8 to 1 imbalance makes those bubbles look conservative. The US economy is effectively betting its future on a technology that isn't producing tangible value, yet. Corporations justify the spending as long-term infrastructure, but what they're building are monuments to speculation. Data centers filled with hardware that depreciates faster than cars. Unlike railways or telecom cables, AI chips lose 50 to 60% of their value in just a few years. So unless revenue catches up at a near impossible pace, these investments become digital wastelands, billions of dollars burning in silence. This isn't growth. It's financial self-deception disguised as innovation. Every dollar diverted into this bubble is a dollar stolen from sustainable industries, from real wages, from economic balance. America's economy has built itself on vapor, promises of exponential progress that never materialize. And when the spending stops, the illusion will collapse under its own weight. The $7 trillion AI dream isn't the dawn of a new age. It's the candlelight before the darkness. If the $7 trillion imbalance revealed the scale of the illusion, the financing behind it exposes its rot. America's AI boom isn't being built on profits. It's being built on borrowed money, circular deals, and accounting smoke. In late 2025, NVIDIA announced up to $100 billion in investments for OpenAI, the same company that, in turn, promised to spend billions buying NVIDIA's own chips. It's a transaction that looks less like innovation and more like financial recycling, designed to inflate balance sheets and maintain the illusion of unstoppable growth. But that's only the surface. Across Silicon Valley, the same pattern repeats. Startups with no products or revenues are raising multi-billion-dollar seed rounds based on slides, not systems. Mira Murati's new company was valued at $10 billion before revealing its mission, a level of blind faith unseen since the peak of the dot-com mania. Established giants like Meta and Microsoft, instead of using their record cash reserves, are quietly borrowing billions through private vehicles hidden from public filings. These off-book debts don't appear in earnings reports, but the interest costs are real and compounding. The corporate debt load tied to AI expansion has now surpassed $1.5 trillion, and much of it is short-term, high-yield financing. It's a fragile web built on trust that growth will continue indefinitely. But if AI revenue disappoints or investor sentiment flips, the entire system could seize. The same mechanism that inflated the market will then amplify its collapse. This is where the illusion becomes dangerous. AI isn't just an industry anymore. It's the scaffolding holding up the US economy. It fuels Wall Street optimism, props up GDP numbers, and keeps consumer confidence from imploding. But that scaffolding is cracking. Every circular deal, every hidden loan, every overvalued startup adds another fracture to the foundation. When the truth surfaces, the collapse won't be technological. It will be financial and it will be national. The danger isn't just that AI is overfunded or financed dishonestly. It's that it has quietly become the backbone of America's fragile economy. Nearly 40% of US GDP growth in 2025 now comes directly from AI-related investment. That means almost half of the nation's growth is tied to a sector that produces little actual profit. When a country's economic strength depends on speculation rather than production, the system becomes a mirage. Bright from a distance, empty up close. Wall Street knows this, yet it keeps the game alive. 80% of the S&P 500's gains this year come from just a handful of AI-linked companies. The rest of the market, retail, real estate, manufacturing, is stagnating or shrinking. The illusion of a booming economy exists because investors keep funneling wealth into the same overinflated bubble. It's not a diversified recovery. It's a single point of failure disguised as progress. And that illusion has spread to consumption. The Federal Reserve reports that the top 10% of Americans now account for 50% of all spending. Their confidence, fueled by paper wealth from AI stocks, keeps the economy afloat. But that wealth isn't real. It's tethered to valuations that could collapse overnight. When those numbers vanish, so does demand. Meanwhile, average Americans are scaling back, skipping medical bills, delaying rent, and living paycheck to paycheck. The US economy, once powered by labor and production, now depends on the digital fortunes of a few thousand shareholders. It's a structure built on leverage, inflated assets, and optimism, not stability. The AI sector isn't driving genuine prosperity, it's masking decay. Beneath the record profits and roaring headlines, America's foundation is eroding, replaced by financial smoke. The economy isn't expanding, it's inflating. And every bubble, no matter how brilliant it looks, bursts the same way. Suddenly, violently, and without mercy. Every illusion collapses the same way. Not slowly, but all at once. When the AI bubble bursts, it won't just erase market wealth. It will detonate the fragile structure that's holding America together. The moment investor confidence shatters, the chain reaction begins. The stock market falls, corporate debt markets freeze, and liquidity evaporates. What vanishes next isn't profit. It's purchasing power, the lifeblood of the US economy. Over $40 trillion of household wealth is now tied directly to equities, and roughly 30% of that sits in AI-linked companies. When those valuations crumble, the top earners who drive half of America's consumption will retreat instantly. Their spending keeps the service industry alive, the housing market liquid, and state tax revenues steady. Once it dries up, layoffs will cascade through every sector, from high-tech to hospitality, from real estate to retail. The collapse of AI assets would ripple through pension funds, university endowments, and municipal budgets. Every dollar lost on Wall Street cuts another from Main Street. Corporate defaults would surge as companies suddenly face mountains of debt they can't refinance. Banks would tighten lending overnight, choking small businesses that depend on short-term credit. It's a domino effect, not triggered by banks this time, but by the overvaluation of belief. And yet, what makes this collapse unique is its reach. AI hype inflated every part of the economy: stocks, wages, consumption, and optimism. So when it unravels, there is nowhere safe to stand. A financial detonation of this magnitude doesn't just shrink balance sheets, it rewrites them. America's economic engine, built on speculation and psychological confidence, would stall in seconds. This isn't a hypothetical future. It's a system waiting for the smallest shock. One earnings miss. One failed IPO. One credit downgrade. The crash won't announce itself. It will arrive quietly in numbers before becoming headlines the next morning. And by then, the damage will already be irreversible. When America falls, the world trembles. The AI bubble is not just an American problem. It's a global fault line, wired into every major financial system on Earth. Over $8 trillion of foreign capital is now invested in U.S. equities, a historic high driven largely by the illusion of infinite AI growth. Sovereign wealth funds from Europe, Asia, and the Middle East have pumped billions into companies like Nvidia, Microsoft, and Alphabet, believing they were betting on the future. In reality, they were buying into a mirage held up by speculation, debt, and hope. The moment the AI market cracks, global portfolios will implode simultaneously. The European Central Bank, the Bank of Japan, and Gulf funds all hold massive stakes in U.S. tech ETFs. A 30% correction in AI valuations would wipe out hundreds of billions from their balance sheets overnight. The result? Collapsing currencies, plunging stock exchanges, and immediate capital flight from emerging markets desperate to defend their currencies. This isn't a local correction. It's a global contagion. The dollar, long considered the planet's safe haven, would become the source of panic. Nations holding trillions in U.S. assets would race to liquidate them, driving the dollar down while spiking U.S. yields. The Federal Reserve, already burdened with historic debt levels, would be forced into a lose-lose scenario: print more money and ignite inflation, or raise rates and collapse what's left of growth. Either choice accelerates the downfall. Meanwhile, global trade would cease. Semiconductor supply chains, cloud infrastructure projects, and digital service exports would stall. Economies tied to U.S. demand, from Germany to South Korea, would face recession within months. Developing nations would confront capital droughts as investors flee to safety, draining liquidity from entire regions. The AI bubble, once celebrated as proof of America's dominance, would expose a terrifying truth. Globalization made the U.S. not invincible, but contagious. When America sneezes today, the world doesn't just catch a cold, it suffocates. The next global recession won't start in a housing market or a bank. It will start in a server room filled with obsolete chips and shattered confidence. In past crises, America always had one escape: debt. When Wall Street crashed in 2008, Washington printed trillions, bailed out the banks, and convinced the world to keep lending. The U.S. could do that because it was the world's safe haven. But in 2025, that illusion is fading fast. The nation's debt has surpassed $37 trillion, growing by $1 trillion every 100 days. And interest payments alone are consuming more than $1.1 trillion per year, more than the entire defense budget. The empire is now borrowing to pay the interest on its own collapse. Global confidence, once unshakable, is fracturing. Central banks across Asia and the Middle East have begun reducing their U.S. Treasury holdings for the first time in 2 decades. The reason is simple: America's fiscal math no longer adds up. Its economy runs on deficits, its stock market runs on hype, and its currency runs on memory. When the AI bubble bursts, the very perception that the U.S. is too big to fail will vanish. Investors who once saw treasuries as safety will see them as exposure. The Federal Reserve, trapped between inflation and instability, will have no good options left. Cut rates, and the dollar collapses. Raise rates, and debt service explodes. Both paths lead to the same destination: default in disguise, not by refusal to pay, but by debasement of value. This time, the printing press won't save America. It will accelerate its decay. And behind the numbers lies something darker: exhaustion. The U.S. no longer produces what it consumes, no longer saves what it spends, and no longer earns the trust that sustains its privilege. Every empire reaches the point where it can no longer borrow belief. The AI bubble merely exposed what decades of debt had already built: an empire on leverage, not leadership. When the final cracks appear, there will be no stimulus big enough, no bailout large enough, and no foreign buyer willing enough to rebuild it. America's power was once measured by its credit. Now it will be remembered by its collapse. When the cracks become visible, the billionaires and policymakers will repeat a familiar lie: that this is a good bubble. They'll claim that, like the railroads of the 1800s or the fiber optic networks of the 1990s, today's AI infrastructure will eventually serve a greater purpose. They'll say that the money isn't wasted, that it's invested in progress. But the truth is brutally different. The assets built during this boom aren't durable, they're disposable. The data centers being constructed across the US, costing more than $1.5 trillion collectively, are filled with silicon that loses half its value every 2 years. Unlike the railways or cables that became national backbones, AI's hardware is designed for obsolescence. The chips that define this era will be junk by the next upgrade cycle. That means when the crash comes, there will be no hidden value, no second life. Only mountains of outdated machinery and debt-financed wastelands consuming power, but producing nothing. The myth of the good bubble dies under the weight of technological decay. And this illusion has moral consequences. Each dollar poured into redundant GPUs is a dollar stolen from sustainable industries, from housing, healthcare, and infrastructure that America desperately needs. The same leaders preaching innovation are draining national productivity for vanity. They're not building a foundation, they're burning one. When these assets depreciate, they won't empower society. They'll burden it with maintenance costs, stranded energy grids, and abandoned mega projects. The difference between past booms and this one is simple. Those bubbles built something tangible. This one builds dependence. Dependence on speculative credit, fragile chips, and corporate giants that can collapse in a single quarter. The myth of the good bubble is propaganda for the desperate, a way to glorify failure before it happens. This isn't creative destruction, it's destructive creation. And when the hype fades, the data centers won't be monuments of progress. They'll be the ruins of ambition. America isn't investing in its future, it's mortgaging it, chip by chip, server by server, until nothing real is left to save. Every empire dies the same way, not from invasion, but from internal rot disguised as progress. America's economic engine, once powered by production, innovation, and labor, is now sustained by leverage, illusion, and speculation. The AI bubble didn't create this weakness, it revealed it. For decades, US growth has been engineered through artificial demand, easy credit, inflated assets, and government stimulus, while real productivity stagnated. Now, the illusion